Look, there's a crisis brewing in the student loan market. Right now, a record 13% of all federal student loans have transitioned into delinquency. That's the highest number we have ever seen since they started tracking this data back in 2003. And if you're short on time, here's the single most important thing you need to understand. This crisis, which seems like terrible news for a company like SoFi, is paradoxically the very thing that proves their business model is built to last. What Wall Street sees as a headwind, I see as a massive validation of their strategy. Oh, and you might want to hear about my new conclusion on that $1.5 billion capital raise recently. Stick around and I'll show you the data and technical picture that explains why. Hey everyone, DataCat here. For those of you who are new to the channel, welcome. I'm not some guru on a private jet. For years, I was an analyst, a corporate slave really, tucked away inside a Fortune 50 company, just staring at spreadsheets all day. I eventually traded that life for well more spreadsheets, a laser pointer and a keyboard. The main difference is now I don't have a boss and I can share what I find directly with you. My goal here is simple, to cut through the noise and look at the raw data. My only boss is my cat, and frankly his idea of a bull market is when he successfully knocks a pen off my desk. If you find this kind of deep dive valuable, I'd really appreciate it if you'd consider subscribing. It helps the channel a ton. Alright, let's get into the numbers, because they tell a pretty compelling story. So, the student loan payment pause ended, and the fallout is starting to show up in the credit reports. In the second quarter of this year, 2025, transitions into serious delinquency, meaning more than 90 days past due, spiked to 13%. And it's hitting older borrowers surprisingly hard. For people aged 50 and over, that number surged to a massive 18%. Think about that. Nearly 1 in 5 older borrowers are in serious trouble. For the 30 to 39-year-old group, it's an all-time high of 11%. Now the obvious, surface-level take is that this is a disaster for SoFi, because you should already know. Their name is basically tied to student loans. A student loan crisis creates negative headlines, and if 13% of borrowers are falling off a cliff, it means the pool of customers to refinance is shrinking. That's a logical conclusion, and it's probably why you're seeing some pressure on the stock. But that's the first layer of the onion. When you peel it back, you see what's really going on. This crisis is acting like a giant filter for the entire market, and it's separating the high-quality lenders from everyone else. This gets to the core of what SoFi actually does. Their entire student loan business was built to serve a very specific person. They call them Henrys, high earners not rich yet. These are people with good incomes and high FICO scores. The folks who are becoming delinquent by definition wouldn't qualify for a SoFi loan in the first place. So what this crisis really does is it validates SoFi's strict underwriting. It proves their discipline isn't just a talking point, it's a protective moat around their business. While the broader market is deteriorating, SoFi's portfolio of high-quality loans remains insulated. It's like my cat refusing to drink water from the toilet. He has standards. SoFi has standards. Now, think about the other side of this. What about the 87% of people who are still making their payments? For them, the pressure is immense. They see these headlines, they feel the economic strain, and it creates a powerful incentive to take control of their finances. This environment makes SoFi's offer to refinance to a lower interest rate incredibly compelling. It's no longer just a nice thing to do. For a responsible borrower, it becomes a crucial financial move. The crisis, in a strange way, acts as a giant marketing campaign that funnels the most creditworthy borrowers directly to SoFi's doorstep. And this brings me to the next point, the genius of their diversification. As you might know, SoFi isn't just a student loan company anymore. Their other segments, like their loan platform business and financial services, have been growing like crazy. This crisis shows why that strategy was so important. They didn't put all their catnip in one basket. Even if the student loan refi market shrinks for a bit, they have other powerful engines driving growth. This is where their recent $1.5 billion capital raise starts to look less like a routine financial move, but rather a very calculated one, like they already knew something. With this new delinquency data as the backdrop, the purpose of that cash becomes crystal clear. They plan to use it for both defense and offense. First, the defense. In a deteriorating economy, cash is king. Fortifying the balance sheet sends a message of stability to investors, regulators, and especially to the banks and institutions who partner with them on their loan platform. It says we are solid, even if the environment is shaky. But the offense is where it gets really sharp. While weaker competitors get scared and pull back, SoFi can use that capital to lean into the chaos. They can aggressively go after that 87% of borrowers who are paying their bills. They can scale their marketing and capture market share from lenders who are running for the hills. Most importantly, it allows them to pour fuel on their loan platform business. See, other institutions are now terrified of underwriting student loans, but they still want access to the high-quality returns from prime borrowers. SoFi can now use its capital to originate more of these high-quality loans, which they are experts at identifying, and then sell them to these other institutions, collecting a fee. They become the trusted gatekeeper to the only part of the market that's working. The capital raise allows them to scale this operation at the perfect moment. Okay, so that's the fundamental story. But how does this translate to the stock chart? Let's take a look at the technicals. As of Friday's close, August 8th, SoFi was at 22.1, testing the top of this $18 to $22 range it's been in. The key level, the line in the sand, is 22.2. That's the anchored VWAP from the earnings report, the average price paid since all this new information came out. Now let's talk about volatility. The stock's average true range, or ATR, is about $1.14. This just measures how much the stock tends to move on an average day. Using that, we can get a rough statistical estimate for a 1-week expected move. For SoFi, that gives a plausible weekly envelope of about plus or minus 255. So, based on the current volatility, the market is pricing in a potential range between roughly 1960 cents on the low end and $24.70 on the high end for the next week. And here is where the macro picture I mentioned in the previous video becomes so important. The overall market, especially the Fed's next move, could easily push the stock to the edges of that range. For August, there are two main scenarios. One is the vitamin shot scenario. The Fed makes a rate cut, the market loves it, and we get a broad risk-on rally. This could provide the tailwind to push SoFi not just above the 22.20 cent breakout level, but maybe all the way toward the top of that expected range near $24.70 before we enter the seasonal weakness in August. The other is the antibiotic scenario. The Fed cuts rates, but the market interprets it as a sign that the economy is genuinely sick. In this case, you'd expect more chop and fake-outs. The stock might spike above $22.20 for a moment, a classic whipsaw, but fail to hold because there's no real conviction. The buying dries up and it falls back into the box, possibly testing the lower end of that weekly range near $20. This is precisely why I'm so focused on volume. A macro-driven rally can create a price spike, but it might be hollow. A true, sustainable breakout above $22.20 needs to happen on high volume. I'd want to see at least 1.2 times the 20-day average. That's the signal that large institutions are committing capital and believe in the fundamental story. Without that volume, any pop is suspect. Right now, the momentum has cooled off, which is perfectly normal when you hit a resistance level. The trend is still bullish, but the stock is taking a breather. But the setup is constructive. So if we get that high volume close above 22.20, the next logical targets are up around 23.40 and then the 52-week high near 25. What would break this bullish setup? If the price were to fall and close below 20.85, that would be a major warning sign. And a further close below $20 would tell me the bears are probably taking back control for a while. So, to bring it all together, the student loan crisis is a real damaging event for many people and for the lenders who serve them. But for SoFi, it's a purifying event. It weeds out the customers their model is designed to avoid, it validates their disciplined approach, and it makes their value proposition shine even brighter for their target audience. The stock chart is coiled and waiting for a confirmation signal. This is what we do here on this channel. We look at the data, we try to understand the full context, and we build a thesis. If you enjoyed this breakdown, I'd be honored if you'd hit that subscribe button and join us. Thanks for your time today. DataCat out, stay sharp and stay safe in the coming weeks.